5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to this episode of the Follow the Money podcast. My name is Jerry Robinson. Thanks so much for joining me today. We're back with another episode, and this episode entitled, well, actually, it's episode number 498, entitled Safe Money versus Risk Money. I want to talk about something that really sits at the heart of every good financial plan today on today's episode. It's really that balance between safe money and risk money. You know, most people never think about this until they run into trouble. They pile everything into the wrong bucket, and then usually the risk bucket, and then when market turns, they feel the stress, they lose sleep, they even panic and sell. And right now, with the volatility in the market, it's probably going to happen to several people, and it doesn't have to be that way. Today, what I want to do is I want to introduce you to our 3-bucket strategy and the many forms that each one of those buckets can take. I'm going to share with you how your mix can evolve as you age and why the right balance can protect both your money and your peace of mind. Now, that'll be in segment 1. And then we'll take a look at the markets in segment 2 and talk about what I'm seeing out there this week and in the weeks ahead. So stick around. I think this conversation is going to really help you see your own financial life a little more clearly. Let's get started. All right, so, when I talk to people about their finances, I find that most folks are holding a mix of assets without really any bigger framework behind it if they don't have a financial plan. Many people don't. They often have some stocks, they might have a little cash in a savings account, they might own some precious metals, maybe a little bit of digital assets, but there's really no structure, there's really no order. And when the market pulls back in any kind of meaningful way, these folks can really feel tension because they never really were taught how to organize their money in a way that protects their peace. And that's why I think this podcast episode is one of the most important we've done in some time, is what I want to teach you today is the 3-bucket strategy that I have been teaching to my own clients for many years. It basically gives you a simple way to think about every dollar that you own. I call it the 3-bucket strategy. You have liquidity, you have stability, and then you have long-term growth. So let's go through each of these 3 buckets. Envision your own financial plan, see how it differs from what I'm talking about here, and I think it'll really be helpful for you. So let's begin with that very first bucket. There's 3 buckets. The very first bucket is what we call your liquid assets, your liquid bucket. Now, this is obviously what? Well, this is obviously your cash, right? This is your liquid asset bucket, your savings, your short-term reserves. This bucket basically serves to protect all your other buckets, right? When life happens, you're going to go to your liquid asset bucket and you're going to pull money out of there. That way, you never have to sell stocks during a downturn or cash something out long-term at the wrong time, right? Liquidity in your financial plan is going to breed or build confidence, and it's going to steady your mind and give you that peace of mind that we really need to have as long-term investors and as just financial actors in this economy. So the first bucket of the 3-bucket strategy is that liquid bucket. I talk about it all the time here at Follow the Money. You can go to followthemoney.com/5 levels. We talk about the need to have 6 months liquidity at all times, 6 months of income, and that's your liquid bucket, right? It's your opportunity pool of capital. It's that cash that you can have on hand in times of emergency or opportunity. Now, the second bucket is what we call the safe growth bucket. It's the safe growth bucket. Now, this is where you protect your principal while still earning a reasonable amount of growth. Okay, so think of things like CDs, certificates of deposit, or fixed indexed annuities, even cash value life insurance or savings bonds, right? There's other certain fixed products, maybe even certain types of bonds, like maybe municipal bonds, tax-free municipal bonds, which I really like. The goal here in this second bucket, the safe growth bucket, is stability, right? So this bucket helps you sleep well at night, right? That's the old swan song, SWAN, sleep well at night. Well, this is also where people start to shift more of their assets as they get older. As I'm getting older in my age, I'm finding that the safe growth bucket is beginning to attract more of my money because as you get older, of course, your risk tolerance is going to change. Now, it's important to realize that safe growth is not about, doing nothing, right? It's really about keeping pace with inflation without putting your money in harm's way. That's why we call it safe growth. You have to put this money into things that have guarantees. So it's important that we make sure that the safe growth bucket is focused upon things that are earning reasonable growth, but at the same time, we're not expecting any kind of outlandish growth. That's what we reserve for our third bucket. Okay, so the first bucket is our liquid asset bucket, right? It's our cash reserve. The second bucket is our safe growth bucket, where we protect our principal while still earning a reasonable amount of growth. Now let's move on to that third bucket, okay? And as I mentioned, this is where a lot of people kind of stuff all their money, and this can be good, but it can also be bad. Let me talk about this. So the third bucket, your risk growth bucket, right? This is where you build wealth over the long haul. This is where you're going to have your stocks are going to be in this third bucket, your risk growth bucket, ETFs, precious metals, digital assets, real estate investing, these kinds of things. These assets carry risk, but they also carry reward. And your allocation here should really be a function of your age, your goals, your risk profile, your temperament, your psychology. This bucket is really building hope for your future, but it also comes with what? It comes with volatility, right? Unlike your cash bucket, right? Your very first bucket or the second bucket, the safe growth bucket. This risk growth bucket, it doesn't have any guarantees, right? It's got a lot of volatility. And when this bucket is filled up too much, if you put too much money here relative to the others, then the normal ups and downs of the market and the volatility, they will begin to wear on you. And it'll start to mess with your psychology, right? Many people know this. This is when people begin to panic sell, right? When they're over leveraged, they have way too much money into the market, too much money in the risk growth bucket, and so emotions can really take over here. The real challenge most people face is psychological, as we've talked about many times on this broadcast. When times are good, people tend to overweight their risk growth bucket. They see their friends making money. They see headlines about big gains. They feel like they're missing out. So they shift more and more of their money into that third risk bucket without realizing what they've done to their emotional tolerance and maybe the balance in their psyche. And then comes the downturn, right? And it always comes. Suddenly their account is down 20, 30%. The fear begins to set in and stress is on the rise and sleep is not coming to you. You have some insomnia, sleep is disappearing. For many people, the emotional weight just becomes too much. They panic and sell. Not because they had the wrong investments, but because they put too much of their net worth into the wrong bucket. They misjudge their own psychology, right? So finding balance across these three buckets is and quite frankly, it's much more than a financial decision. It's a psychological decision because a well-balanced plan helps you stay steady through life's storms, all the different things that we're going to see over the next, several years. If you have we talk about a, well laid out financial plan. Really what we're talking about is making sure these three buckets are adjusted properly, right? And when you have those three buckets in proper alignment based upon your own psyche, based upon your own risk profile, your age, then it's going to keep you from making costly mistakes in moments of fear. It'll keep you from taking unnecessary risks too in moments of excitement. And this is why that safe money bucket right in the middle, that second bucket, that safe growth bucket is so important because it creates emotional stability. It keeps you from having to sell out at the worst time. Also that first bucket, right? these first two buckets are often overlooked, and we immediately go for the high risk. We immediately swing for the fences, right? And that can really stress you out when things go against you. So, again, having that safe money creates that emotional stability. It keeps you from having to sell at the worst time. I could give you so many examples over the last 10, 15 years of individuals who were overly putting money into risk assets. And then when the market swooned, they sold. They sold at the worst possible time, right? And this can really devastate your psyche. It can really devastate your investing confidence as well. So the safe growth bucket gives you a cash cushion so you're not forced out of positions or out of a plan that would have worked if you had simply stayed patient. Now, let me remind you also, this is not a one-size-fits-all strategy, right? Your mix should match your goals, your income, your savings rate, your family needs, and your own emotional wiring. That's why what works for somebody, for someone else may not work for you. Also, don't forget, each of these buckets have their own tax rules. Some dollars grow tax-free. Some grow tax-deferred. Some are fully taxable. So knowing which bucket to use for what purpose can save you a lot of money over the long run, too. And that's what a good financial advisor can help you do. And that mix, of course, should change across those three buckets as you age. In your 20s and 30s, you can definitely handle more risk, right? You can be putting a little more in that third bucket, assuming that you have some liquidity because you have time to recover. Now, in your 40s and 50s, you're going to start shifting, right? You're going to build a real safe money foundation. You're going to protect that income that you've worked hard to earn. You're going to protect your family, and you're going to really be focused upon protection much more so than you had in the past. And then by your 60s and 70s, safe money, the safe growth bucket is going to become the core, right? Risk money is like seasoning on the steak. It's not the main course, right? At that point. And so I just got to tell you, when I look at the many different people I've talked to over the years, people I've coached, people I've put in touch with financial advisors and all of this, most of the financial mistakes that I've seen are not mathematical mistakes, right? They are emotional mistakes. And emotional mistakes always happen when someone has too much money in the wrong bucket. That's what I've seen over and over and over again. In fact, I'm sharing more about this three-bucket strategy with our members. In fact, we have a brand new article up on our website as well. We'll put a link to that in today's show notes. You can read because it's one of the most important concepts that I teach. But for today, what I really want to do is just get you thinking about it. Do you have liquidity, right? Do you have safe growth? Do you have anything in that safe growth bucket? Or is everything in the risk growth bucket, right? And maybe that's fine because of your age, but maybe it's not, right? Everybody's different. Do you have these buckets that are balanced, right? Or are you leaning too heavily on one and hoping for the best? See, understanding this early can save you a lot of pain later. Just talk to somebody who had these things out of whack, and they will be the first to tell you that it will really help you to build a plan. It'll bring order, clarity, and peace to your financial life, right? That's much more important than profits. Peace in your financial life is extremely important. So the goal is simple. Know the purpose of each of these three buckets and begin building them, right? I encourage you, if you're interested in learning more about our financial philosophy, go to followthemoney.com/5 levels, and then also check out the show notes today, and you'll see that link for the three-bucket strategy that I'm talking about. You can go learn more about that. We'll have a lot more information coming about that very soon on our website as well. So stick around. We'll be right back with our next segment. We're going to dive in and take a look at the markets and see how things are happening. Hold tight. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the Follow the Money podcast. My name is Jerry Robinson, founder here at followthemoney.com. Now, what I want to do in this segment here is I want to get into our latest market commentary. I want to share some of my latest market comments with what's going on in the markets. We've been seeing a little bit of weakness in the broader financial markets, but certainly in the crypto market, seeing Bitcoin as of this recording back down below 90,000. It's been quite some time since we've been at the $90,000 level. You got to go back to the Ides of April, back in the wake of the Liberation Day tariffs, where there was a lot of weakness, of course, across the market. We've seen a pretty healthy pullback here in Bitcoin to around 89,000. This morning, we see Ethereum also trading below 3,000. Again, for the first time there since around July, maybe early July was when we were last there. So, not incredible sell-offs, but at the same time, kind of maybe surprising sell-offs, given the fact that many were expecting, myself included, that we would see a rally into the end of the year. Now, the end of the year isn't here yet. There's still, 6 weeks or so. It's highly unlikely that we're going to see a move that's, going to get to where we were thinking that Bitcoin would get to by the end of the year. That may be delayed into next year. But regardless, we could see a rally. So the year is still, not over. Now, obviously, before I get into some of the other markets, I want to talk about S&P and Nasdaq and gold and silver, et cetera. But before we do, remember, Nvidia is reporting after today's close. Now, I'm recording this at around, 11 o'clock Central Time on Wednesday, the 19th of November. This is the day when Nvidia is going to report after the market closes. It's about 4 hours away. Now, as you know, when Nvidia reports, it's kind of a barometer for the broader AI theme. So when Nvidia surprises to the upside, the entire Nasdaq tends to follow. And when it disappoints, which I don't expect it to today, but nonetheless, the market still may be react in a strange way even to a good report. But, if it does disappoint, of course, the market could definitely run into some, hefty, headwinds. So we don't have the results yet. Just know that today's report could really set the tone for tech as we move into the rest of the week and into the weekend next week. And then secondly, there's another market moving event that you need to be aware of, and that's Thursday morning. We're going to get that long delayed jobs report, right? Jobs data still shapes expectations around the rate cuts. And rate cuts right now, Fed futures market showing that, there's about a 50-50 chance of a rate cut in December. I expect there to be a rate cut, but nonetheless, this jobs data is going to really shape expectations around that decision. We already know that the Fed is preparing to cut again, most likely, but the pace and intensity of those cuts is really going to depend in part on labor market data. So if we get a soft report, that could fuel hopes of a faster pivot towards, rate cuts. So we're going to find out, what we have tomorrow morning. So either way, expect volatility around that release and, of course, the release of Nvidia earnings. Now, aside from all of that coming news, let's talk about where things stand right now. We have been seeing the S&P pull back a bit. It's still sitting in a long, strong uptrend, right? A long-term uptrend. Earnings remain very solid this quarter. The bubble chatter around AI, that's enormously loud right now. But valuations in many of these companies are nowhere near the extremes of the early 2000s. We keep hearing allusions to the fact that this is like the dot-com bubble or whatever. But corporate balance sheets and cash flows look much stronger today than we saw back then. Nonetheless, the S&P has breached its 50-day moving average to the downside for the first time since it broke out above its 200-day moving average back in May. So we are definitely seeing some weakness there on the S&P. In fact, I'm just putting out a new trading idea for all of our members for tomorrow, given all this volatility, that's designed to be a hedging trading idea. That basically, if the market goes and hits a new low for this recent cycle, it'll trigger this idea. And then the only way that it'll be triggered to the sell signal will come only if the market hits a brand new all-time high. So it's an interesting trading idea, putting that out to all of our members tonight by email. Be looking for that. If you're not a member, obviously, go to followthemoney.com/join. Choose your plan. We'd love to have you. We put out new trading ideas for our members every day and lots of great education for traders and investors of all sorts and flavors. Now, let's also talk about if we look at the Nasdaq 100, it looks very similar. The Nasdaq 100, we track QQQ. That ETF falling below its 50-day moving average for the first time since its April and May breakout above the 200-day moving average. So we're seeing some weakness there, right? When we turn to gold and silver continue to digest their massive rallies. They've obviously had great years this year. The consolidation that they're in right now makes total sense, especially after some of the parabolic moves we saw. Gold's long-term uptrend remains firmly up. Silver and platinum look constructive here. Even all the volatility we have had has not really changed the story for this. If we look at physical gold, it hasn't even pulled back to its 50-day moving average yet, right? It is facing some rough resistance up to the 43.80 level or so. But overall, we're still locked in a big long-term uptrend on gold. But we may just have to churn for a while below that recent all-time high to digest those gains. One thing that we are seeing today, however, before I get to silver, is the U.S. dollar. It's been flirting with that 200-day moving average, trying to break back above it since it lost that, way back in March or so. But since that time, it's been struggling and have obviously been down pretty hard this year. Well, we just crossed above the 200-day moving average in today's trading session. Whether it holds above that into the close, we'll have to see. Obviously, the jobs report tomorrow will obviously have some sort of impact on that dollar as well. If that thing begins to show some resurgence continually, then that could pressure the gold and silver markets, and not just those, but many other markets as well. In fact, when we look across the markets as of right now, we are seeing some pressure caused by that resurgent dollar going back above 100, that U.S. dollar index. 101 to the 100 to 101 range is the area we expect to see that resistance at. So we'll see if the dollar can hold its gains there or if it gets back down. Much will depend upon some of the forthcoming data. And then let's also talk, as I mentioned, about silver, because silver is also holding up very well. Recently got back up to $54. It pulled back to around the $50 level. It seems to be holding that $50 level pretty well, just like gold is holding the $4,000 level. But again, there's just a lot of overhead resistance here for silver, which may cause it to struggle a bit more in the near term. I don't think the rally in gold and silver is necessarily over, but I think we've had such parabolic moves that you got to expect some consolidation of those gains. As I mentioned, Bitcoin is struggling. It's been making lower highs and lower lows, really kind of forming a new position downtrend. We're on the verge now of a new long-term downtrend in Bitcoin, which is really quite something. Lots of weakness there. We recently lost the 50 weekly moving average. That's a really key area that we were watching on Bitcoin. And if we look at Ethereum, for example, we see something similar. It's trading below 3,000. That's well below its 200-day moving average. And it's also, below its 50 weekly moving average, which it just lost over the last week or two. So it's also lost that area. So there is a lot of pressure right now on crypto. For those who have a longer term time frame, I think this is an opportunity. In my opinion, that's how I'm viewing it. That's what I'm doing. I'm continuing to add to my positions in high quality assets across the stock market and also across the digital asset space. But these are, places that we're looking. Remember, crypto remains a high risk, high reward area, right? Nothing new there. For long-term investors, nothing about this recent pullback changes the bigger picture. In fact, we have bullish things ahead, such as the market structure bill, which we may see come. I heard from the CEO of Coinbase saying that he expects to see the market structure bill potentially in December. We'll see if that actually happens. And so we'll be watching all of that. The bottom line here, friends, is that you really want to just follow that trend. We got these big data points coming over the next 24 hours. We've got Nvidia reporting. That's going to be a big market mover. We got the jobs report coming up in the morning, and those will move markets certainly in the short run. But they also don't replace the bigger forces that are shaping this long-term picture as we look ahead. So my best advice here is to remain prudent, stick to your plans. Don't get too panicky in this kind of environment as you see the sell-off. Try to think in terms of opportunity if you have a longer-term time frame, right? That's a very vital piece of advice for you. All right, with all that said, let's move into a quick break. We'll be right back with my concluding thoughts. All right, friends, welcome back to the final moments of today's episode. And as we wrap up today, I want to leave you with something pretty simple. The weeks ahead are going to be noisy, right? Nvidia's earnings after the close today could send the market higher, could send it lower. Tomorrow's jobs report could shake things up a bit too. That's the nature of the markets. They move, they react, they adjust, and they're always repricing risk. But none of this changes the value of having a clear financial plan, because when you know what sits in your liquid bucket, what sits in your safe growth bucket, what sits in your risk growth bucket, you stop reacting to every headline. You stop checking your portfolio 10 times a day. You stop letting fear push you into decisions that you end up regretting later. See, a good financial plan gives you stability in the middle of uncertainty, and it gives you permission to sleep well at night. And if you happen to be one of our listeners who is thinking about the need in your financial plan right now, maybe you need more money in your safe growth bucket, or maybe you've got too much in the risk growth bucket, or if you just want a second set of eyes on your financial plan, feel free to reach out to us. You can contact us on our website, followthemoney.com/advice. Right there, you can fill out a quick form and schedule an appointment with me. I'll be happy to talk to you, go over what you have going on right now, and if it's appropriate, put you in touch with a financial advisor who can help you. You see, we help people every day understand their options and build a plan that fits their goals and their season of life. So here's my final word for you today, and it comes from the famed value investor, Benjamin Graham. We've said it before, we'll say it again. Here's what he said: the investor's chief problem, and even his worst enemy, is likely to be himself. That's it. That's the battle, right? If you can learn to steady your mind and get your emotions under control, the rest becomes much easier. I promise. Thanks again for joining me today, friends. I appreciate you so much for tuning in. I look forward to our next episode. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.